Welcome. I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Vince Stefano, where we're here to provide you insights on the markets, planning, and much more. Today is January 8th, 2026, so Happy New Year to everyone. Obviously, we were gone for a couple weeks, so it's nice to be back, and thought I'd kick it off by giving you a recap of where we ended up at the end of 2025. So as of December 31st of 2025, the Dow Jones was at about 12.97%. The NASDAQ, which is mostly tech stocks, ended about 20.36%, and the S&P 500 was at 18.76%. So obviously we ended up on a positive note. Obviously it was an interesting year, the beginning of the year to where we ended up, but I think all in all we were pretty happy with the returns we ended up with some of the indexes this last year. And here we are the first week in January, and the markets are up. I mean, we had a little volatility over the last few days, but even looking today, the markets are up. So as of yesterday's close, we're looking at the Dow Jones is up almost 2%, NASDAQ about 1.5%, and the S&P about 1%. So obviously we're having a good start to the year. It was interesting. I was reading an article in the Wall Street Journal, and the headline was, "Will stocks crash in 2026?" And so here we are. Obviously, the probability I read in the article was about 30%. We haven't seen a crash since COVID. I'm not really hearing that there's going to be a crash this year, but obviously there's still a lot.
When you say crash, what are you referring to exactly?
Well,
how far down does it have to go?
Because we did see some, market corrections,
yes.
and even in 2022, we did have a correction. But I think looking at the COVID year. Obviously, we ended up positive that year, but the S&P 500 that year was down 34% at one point and ended up...
In about 3 weeks, I think.
Yeah, ended up positive
it was
16.
quick.
Yeah, so that was a 50% move in 1 year, which is pretty aggressive.
So what did your article say as far as it crash going?
Basically, it was saying that October 1929, 1987, and 2007 were the crashes. And then the last crash was 6 years ago during the COVID, which obviously with that, we did see some positive returns. But with some of the analysts, what they were looking at is, would there be an estimated chance of a 30% drop is kind of what they were looking at.
So yeah, more than a 30% drop is what they're defining as a crash. And the bear market people refer to as usually 20%.
You're talking from top to bottom, 30%.
Yes.
Yeah. Okay. Right.
So anyways, obviously there's still a lot of headlines, but the markets are in positive territory for the first week of the year. Looking at interest rates, I was just kind of looking at the probability of a rate cut, and the next meeting, looks like the meeting's January 28th of 2026, and the probability of no change is about 88%. So it looks like we're not going to see any changes for this first meeting. And looking at kind of where we're at with interest rates, the 1-year CD is at about 3.6. And the 1-year Treasury is about 3.52. So obviously those have come down a little bit, but we haven't seen much movement over the last couple of months. So that's a little update with where we're at. I don't know if you want to chime in.
To all of my listeners, I have a little bit of a mea culpa for 2025. First of all, I predicted that the S&P would do 20%. It did not. It did 18.7. So it was still a really good return.
Pretty close, Vince.
I also predicted that we would have a Santa Claus rally. That didn't happen. However, most Santa Claus rallies end on the 5th of January. But as Catherine was saying, from the 5th of January to the 7th yesterday, we've had a solid upside of the market. Most of that was tech-led. And a lot of that is because a significant amount of money flows into the market the first few days of the year because people start funding 401ks and other retirement plans. So you start seeing a lot of big investment houses start putting money to work. And finally, I thought the mega cap growth stocks were going to do well at the end of the year. They did not. They kind of fizzled and just kind of did nothing. My crystal ball for the first half of 2026. I'm just going to go first half because, I want to be able to, adjust. It's like playing golf. You have to adjust on the golf course when things don't go.
I think there's a lot of things that are going to change in that second half too, potentially. So good call.
Yeah. So first of all, in the first half of 2026, I think you're going to see a lot of market volatility. and especially as investors begin to digest what's going to happen with the one big beautiful bill, which I'm sure Rachel will have something to say about that. You're going to have cuts in income tax rates. You're going to have, cuts in business regulations. My guess is interest rates and inflation will continue to trend lower, especially as oil continues to trend lower. I think there's a lot of talk about sector rotation, and I'm not a value manager, and so I focus more on growth stocks. And I think within the area of growth stocks, I think one of the areas that you're going to see investors focus on going forward is the software sector. And the reason I say that is because, one, the sector is extremely innovative. Number two, it has a dramatic effect on companies' top and bottom line. Number three, it's huge, high-margin business. And so the fourth reason is it significantly underperformed the S&P and the NASDAQ for 2025. I think the sector was only up about 5% for the year, which dramatically underperformed. But I think the first half of 2026, I think what you're going to see is investors focus on infrastructure names. And the reason I say that is because these are the big enterprise names that run operating systems, they run databases, they are, they function as the network carriers, they function as, the communications amongst other areas within your network. And so I think investors will focus on that in the first half of 2026, and I think the second half of 2026 you'll move more towards the application side, and the application is the end user side. And so that's kind of like my focus over the next kind of few months. I want to see how this area does, and I'm looking at a number of names that I'd like to participate in, especially if the fourth quarter earnings reports don't come in as robust as you'd like to see them. So I've got a lot of dry powder, and I want to I'm looking there, and I'm also interested in a lot of the healthcare names that are being not so much healthcare or pharma or anything like that, but I'm talking about more interesting names that are doing a lot of testing, that's doing a lot of diagnostics, R&D, and so they're using AI capabilities to really enhance those company sectors. So anyway, there's a lot to look at in 2026. I'm glad I've got 360 some odd days that I can.
And it was interesting, not to just pick one day, but the defense industry stocks were up pretty significant before they opened. They were up over 8%, and so obviously
today,
they were down huge yesterday before
the announcement.
Trump gave the second half of this
the White House
Yeah.
announced they want to have military. They want to have a military budget of 1.6 billion or something like trillion. I mean, it's huge.
So there's been a lot of volatility there, and I was surprised the markets didn't move as much just last week. But that's a whole other story.
That's a good point, and that's kind of like what we're going to see. We're going to see big. You're going to see sectors move as news comes out very favorable, or sectors may move because you get some standard deviation events to the downside. So anyway,
I think this year is going to be a lot more about the tweets coming out of the White House. I mean, the defense stocks took a major hit because Trump said we're no more dividends from these defense contractors. Executive pay's got to be, in check. No more stock buybacks. Crushed the stocks. And then 5 hours later, he's like, but we're going to increase the budget by 50% next year. So, it's going to be a lot of tweets out there that make things move. How much the move sticks depends on the next tweet, I think. So it's going to be volatile. I think AI is, like you said, is going to have a big impact. I'm curious, the software stocks took a big hit last year. They underperformed because of the threat of AI. But you think that AI is going to?
Well, I think there's a lot of software companies that are using AI to significantly enhance how their performance impacts companies that utilize that software. So I think the monetization of that AI is going to happen, through the first half, but mostly in the latter part of the first half of 26 and on into the second half. And then, as I've said all along, 2027 I think will be a huge year for AI monetization. So, again, I'm cautiously optimistic, and I think this sector deserves to be looked at because it underperforms.
It has underperformed greatly.
I mean, it got trashed.
Yeah.
So I'm going to jump in and talk about tax season.
Here we are.
Oh no! April 15th is right around the corner.
Well, it's funny you say that because last weekend I spent my weekend getting everything organized. So
Absolutely. Of course you did.
I did, of course. And I pulled out my donations, and I was.
And this is the time of year to do that because you don't have any of you won't be getting any of your tax forms probably for another 3 weeks, approximately.
If you're lucky.
If you're lucky.
And usually the Schwab stuff doesn't come out till the middle of February.
Yeah. But this is so the IRS has not announced the start of tax season yet, which is not abnormal. But because of the One Big Beautiful Bill Act, I have a feeling it might be delayed a little tiny, and the government shut down last year. Typically, we see tax season open, meaning, so when you say tax season opens, it means you can e-file returns and IRS begins accepting returns. So this is the time of year for you to gather your documents, deductions, like Catherine said. Maybe you went to the DAV or the Goodwill and make sure you get all of those receipts so you can write off those expenses. We're going to see a lot of new tax forms this year, so give your CPA a little bit of grace because there were a lot of changes with the One Big Beautiful Bill Act, and you want to make sure that you're taking advantage of all of those new deductions that are out there. So we'll be navigating new tax forms, yay! But it is a really great time to if you're over 70 and a half, or if you are actually taking your required minimum distributions already, be careful before you take that, because if you take that money and you actually take possession of that money, then you can't take and do the planning with a qualified charitable distribution. You can't give it back. So we want to make sure, well, you can do the 60-day rollover, but if you want to do some planning as it pertains to donations and your IRA, make sure you're call us. We're happy to chat about that. And help you with some planning surrounding that.
I thought they changed that it didn't matter if you did the charitable distributions.
You can give more
first.
money later, but if you let's just say if your required minimum is $20,000, and you take the money and it goes into your bank,
the whole amount.
Then you can't say that money's not taxable. You actually have to pay tax on that $20,000.
Gotcha.
So.
If you took 10 of it, you still have 10 more you could donate later.
Correct. Yeah.
Okay.
Or reinvest it or do something.
Correct.
Do whatever. Okay.
But the goal with the qualified charitable distribution is you're not including that required minimum amount that you have to pull out in your taxable income. Right. Because as most people know, Social Security's the amount that is taxed is dependent on your other income. So there's some planning opportunities there that you want to take advantage of. And I was also going to say this is a great time of year to adjust withholding, or if you adjusted your withholding at the very end of the year for IRA distributions or your wages, make sure you're looking at it at the beginning of the year and don't wait until you get your taxes done in April or May or late summer to adjust withholding, because you might be in for a huge surprise. Other things that people want to think about at the beginning of the year is making sure their 401k contributions, that you're maxing those out. Because sometimes you have some sort of event in your life and you've said, I'm not going to contribute as much. So time to reevaluate that and make sure you're ready to go for the year.
Which ties into January is a good time to review your financial plan.
Yes.
We actually just did a Savvy series on goals and word for the year and mindset. So if you have an interest in reviewing your financial plan, we're happy to look at that with you. Obviously, we're in a new year now. It's a new tax year, and we want to get ahead of it. So definitely we're available to work with you on that throughout the year. But
time to be intentional.
Yep.
Hey, Grego, you got a lot of charts over there. What's
I mean, there's, just looking at, you were talking about the first half of the year too, and I think that there's a lot more upside potential to the first half than the second half. We've got the fiscal impulses that, with the new administration, we got financial conditions are looking good. We're probably, we aren't lowering, the Fed's not going to lower rates in January, but, we're probably going to get one or two, quarter point decreases. So I think the first half of the year is going to be looking pretty good. We'll have big amount of tax refunds coming in to support this market, but it's that second half depending how, the people feel, we have a midterm election coming in November, and if, the Republicans lose the House, a lot of the things that the current administration is doing that apparently the markets like, the economy's doing pretty good, but that's going to put the brakes on things. So second half, I think, is going to be a little bit more questionable. But that depends on the first half. If everything continues to do well, maybe they keep control.
It's all about the economy, stupid.
It's all about the economy.
Hey, I got a
stupid.
question for the table real quick. I'm not a real estate person, but today the White House came out and said that they wanted to restrict big institutional firms
saw
from
that.
buying residential housing.
Yeah.
Is that going to help affordability or not?
It's a good question. I don't think it's going to hurt it. I think it maybe it helps. I don't know.
And with that question, we actually have J.R. Phillips coming back in February for a real
On the
estate
12th.
update. So we'll definitely
We could pose that question to him then.
and make sure get his feedback on that.
Yeah.
I didn't realize that. I heard a lot of the housing builders had special deals for some of these institutional buyers, even on the brand new houses, which that's a problem.
Yeah.
They shouldn't be getting
More
incentives
kickbacks.
for that.
Yeah.
Well, I
kickbacks
was just,
and
I just
stuff.
heard that, and I keep
Yeah.
hearing affordability is a big thing. So
Yeah.
that's why I asked.
Yeah.
So this last week, I had a call with one of our clients' parents, and it's a newer client, but the parents or the father doesn't have his accounts with us, but I building a relationship with him, but he had some questions. And one of the things he wanted to know was if something happened to him, and the money went to his daughter, and want to make sure we'd be able to help her. And I said, absolutely. And we talked through a couple of scenarios. But one of the things that came up was looking at the beneficiaries on their IRAs, which he had his 2 kids. But in his trust, he actually was going to be giving about $100,000 to a charity. So we talked through a little bit, and he's going to meet with his estate planning attorney, because if he changes one of the IRAs and puts the charity as the beneficiary, then the charity doesn't pay taxes, versus his daughter and her family, they're in one of the highest tax brackets right now. So as we're looking at helping individual clients, and there's generational planning, and unfortunately they had a different advisor that they were working with, but I'm happy to collaborate and share ideas. And even our existing clients that are working through and thinking about these, is sometimes you think you have your trust and your wills and your plans and everything in order, but you really have to look at it from the tax perspective too. So
you want your team.
Yeah. So I guess with that, we covered
What
a
about
lot of
greed
ground.
and fear index,
Oh, yeah, I
Catherine?
forgot
Oh
about
yeah,
that.
Where's
Don't
Fear
forget
Index?
that.
How we starting the year out?
Wow.
Okay, so right now we are at 46 out of 100, which
we're
is
neutral.
neutral. So
Yeah.
Perfect.
yeah, it's a good way to start
the year.
Start the year. I'm happy.
Everyone's just kind of
I'm
like,
happy to be here.
okay, where are we at?
Yes.
Where are we at?
Yeah.
Let's go ahead. Take the temperature.
Well, we want to thank everybody for listening today, and until next week, I'll say Steve's slogan: "Happy investing." So thanks for joining us.
Thank you.
Thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.